we will be talking about the economic infrastructure sector. This is one of the 4 alternative sectors that we decided to deep dive. So the infrastructure sector has evolved. We could say that primarily the 3 subsectors in which investors participate are the energy, the telecommunication, and the transportation sector. Now, when it comes to real estate investments, also we need to be selective in what type of infrastructures we want to own. So typically in the energy sector, real estate investors is not going to own typically a power plant. Okay, you just don't see that sort of assets in the portfolio of the real estate investors. But what do you see? It's a renewable energy plants. Like you can find solar farms. Okay? You can find wind farms. Sometimes they are attached to business parks. Sometimes they can be standalone assets. Now, there are 2 ways of investing in wind farms and solar farms. One, which has really been the traditional way, where the government essentially was providing some sort of subsidy or off-take agreement, okay, guaranteed off-take agreement, providing certainty for 20-25 years to the investor as to the level of income that they would have generated by building and operating a plant, a solar farm, a wind farm. The other form which is emerging over the last few years is the so-called subsidy-free or merchant pricing, where the investor sells the electricity to a grid. So here we are really going into more sorts of operation and active management. Within, a middle format has been the power purchase agreements, where there is 20 years off-take agreement from a private sector operator, say data center, to buy clean energy at a price which is fixed in advance with certain rental escalations, which enables the investor to recover their initial investments. Now, again, to deep dive on this renewable energy sector, it is becoming very challenging as of late to invest in this sector. Initially, the amount of subsidies that were provided for the construction and operation of these assets was very generous, and it covered even the cost of installing the wind turbines and the solar panel, which was quite expensive. So the IRRs were much higher, especially going into from the planning to construction and operating stage. But as more and more capital came to realize that essentially there was a free ride, because once the plant was established, the income was basically government guaranteed. Okay, and at the same time, the cost of the wind turbines, the cost of the solar panels started to come down. The governments have reduced or eliminated the subsidies. So on one side, the more and more capital came in. On the other side, the governments eliminated the subsidies, and the investments became more and more exposed to the energy prices. This has created lower returns and higher risk. So the opportunity has certainly reduced. Now we will see over the next few years whether the European governments, the US government, in an effort to increase or decrease, in the case of the European, certainly the reliance on imported fossil fuels, okay, for the US in general, as a strategy of diversification, because they are self-sufficient in terms of fossil fuels. Okay, we will see whether there will be additional subsidies that will make they will stimulate a new way of investments at more attractive rates. The second sector of the infrastructure macro sector, where real estate investors can participate, is in the telecommunication sector. Again, we are not talking about buying a telecommunication company. Okay, for real estate investors, the investors in this space primarily are limited to data centers and telecom towers. The data center is pretty much it's a real estate, it's a property, okay, but it's the value of the physical premises is a fraction of the value of the computers, the servers, which are installed in those premises. Okay, so the basic approach of a real estate investor is to partner with a developer that can operate the premises, okay, and literally limit the investment to the shell, okay, to the cooling system, okay, and to the part of the building that are looking at the power generation. Okay, so obviously there is an external provider of electricity, but batteries have to be installed. Batteries and supplemental generators have to be installed and maintained over time to ensure that the uptime of the data center is maximized. I mean, you cannot have like a data center shutting down for even 1 or 2 seconds. Okay, so the electricity supply has to be extremely reliable, like the connection to the fiber optic networks. So the investor will just the real estate investors will just intervene at this level, and then will let the tenant to place its own servers and even have technicians. Now, this was the state of the art up to a few years ago. The reality is that this sort of investments have become very difficult to source. Okay, there has been a rush of investors, and the yield have really compressed fast. Why? Because the tenants of these data centers are some of the largest tech companies in the world: Apple, Microsoft, Google. Okay, that in their rush to expand their footprint, they have relied on third-party developers. And given extremely long guaranteed contracts to these developers to occupy their space. So it was really a brief opportunity available in the market to own fully leased data centers with Microsoft, Google for 20 years. There was a brief window of opportunities to invest in hyperscale data centers. And now the way the real estate investors can invest into these sectors is really becoming an infrastructure investor. So you need to own the developer. Some real estate investors are involved in the initial phase of planning. So, for example, they have an industrial estate that can secure the supply of electricity. So they do the initial planning stage, and then they sell it still as a project. But it is extremely unlikely for a real estate investor to be involved into this sector. On the other hand, it's possible to invest in data centers that provide co-location. So in this case, the real estate investors tend to own also the servers, but clearly this is no longer real estate. So even if there are in the market data center REITs, for example, that qualify as REITs, okay, because technically the income that they generate is from leasing their premises. These are really infrastructure type of investments. Private sector operators will not be involved into these assets. Also, I was mentioning the telecom towers. Here, it's a very funny situation because the telecom tower, I mean, if you look at the real estate piece, it's very small. And then there is this huge tower with lots of antennas. But again, because the contract with the telecom company leasing the space to place the antenna is a tenancy contract, this infrastructure investments have been qualified as real estate and benefit from the tax status of a REIT. Here, the bigger picture, obviously, is the rollout of 5G communication, the wider adoption of mobile telecommunication that needs these towers. Finally, on the transportation sector, here the opportunities for real estate investors are really, really limited. Okay, we might see investors investing, owning a port, an airport, but again, we are going really into the infrastructure space. So maybe it's possible to own within the premises of an airport and a port the logistic assets, okay, that support the activities of the port, but it's extremely limited. But the bigger picture is obviously that the international trade has increased. The goods are moved very often within a country, so there are opportunities for real estate investors to invest in this area. So why is it important to invest in the infrastructure sector? I mean, what are the mega trends? There is clearly an infrastructure gap. The infrastructures, especially in the Western world, the infrastructure is aging, and trillions of dollars have to be spent to upgrade the power, the power infrastructures, the roads, the telecommunication, water, rail, airports, so the ports. So clearly, opportunities will be there. The governments cannot fund this gap, and they need to rely on the private sector. Also, another important consideration is that we need more sustainable infrastructure. Okay, so if you look at the traditional sectors, okay, we used to have polluting power plants. Today we need cleaner energy. We used to have the digitalization of the economy means that the old telephone lines have to be replaced with telecom towers. The transport, okay, has to become more sustainable and requires electric vehicles. So for the real estate investors, there is an opportunity to invest in charging stations for this to support the growth of the electric vehicles. Now, there are many ways to invest in infrastructure. One is at the stage of development. Okay, there's a brownfield stage and there is a greenfield stage. Okay, so greenfield is really when pre-planning, a brownfield when there is the construction is in progress, and there are also, I mean, for Sharia compliant investors, not all are available. Typically, the Sharia compliant investors will invest in the common equity, but there is also the possibility to invest in preferred equity, mezzanine debt, subordinated debt, and in senior debt. Of course, the risk changes. So the senior debt will take a lower risk, and common equity will take the higher risk. So why would you spend time also in looking at the infrastructure sector? Well, it's because it adds returns and lowers the risk of a portfolio. Okay, when you have this very long contract to the private or the public sector, you tend to have also security of income. Okay, and that makes the return less volatile. Here, I've taken the correlation and total. I mean, the correlation of the total annual returns of several asset classes. And what I would like to really point out is the global private equity infrastructure. Okay, so you can see that relative to equities, they are inversely correlated. Okay, and that's really that's the only number that really matters in this chart. That adding exposure to infrastructure in a portfolio, even if it is limited to the infrastructure that can be characterized as real estate, really lowers the risk and increases the diversification of the portfolio.